they don't need the forward guidance. They've accepted we're not going to have the same level of forward guidance going forward, but they wanted some understanding of the Fed's reaction function. What is the policy response going to be if inflation stays persistently elevated? They didn't get that.
At all.
Not at all. It was, if you ask me, it was a car crash of a press conference. I'm going to give you an example. One of the early questions from a reporter was this: if inflation is too high and not coming down, is the best remedy to raise interest rates?
That's a decent question.
Yep. So Warsh's response is this: it's interest rates could well be part of that solution, but I wouldn't say it's in isolation.
Oh, that's a nice way of not answering a question.
Oh, he was evasive.
What's his name? Alan Greenspan?
No, I mean, he was more evasive than Greenspan. He just, whenever the reporters tried to press him on how are you going to get inflation back to target, he was extremely evasive. And he followed up that by saying the market is already doing some of the Fed's work, meaning that the long end of the Treasury yields have risen. That is effectively tightening financial conditions, which are having a slowing impact
And what
on
did the market
economy.
do? It's done more of the Fed's work.
Well, absolutely.
A lot has happened since last week. Today I'm going to discuss the sell-off in treasuries, the intervention in the yen, the insane vol in the chip stocks, and just to cap it all, a $45 billion hedge fund blew up. Hi, my name is Elvis. Welcome to another Super Macro podcast. Sitting opposite me, veteran hedge fund manager Jonny Matthews.
Hi, Elvis.
How you doing?
All right, thanks. How are you?
Oh, I don't know. I'm having a tricky time trading at the moment.
It's certainly not been straightforward.
Look, Jonny, we had over the last couple of weeks, four of the major central banks had meetings. All of them stood still and did nothing in July. The next meetings are in September. That's going to be a lot different. I want to discuss that. I also want to discuss equity markets. Basically, again, on the surface doing nothing, but the volatility below the surface is insane.
Agreed.
Where do you want to start?
Yeah, well, let's start with the Fed. Let's a quick post-mortem on the Fed because...
Quick?
Well, as we know, look, Warsh has made a big thing about reiterating the Fed's commitment to price stability. So investors went into this meeting
thinking there's going to be something.
They really wanted to hear they don't need the forward guidance. They've accepted we're not going to have the same level of forward guidance going forward, but they wanted some understanding of the Fed's reaction function. What is the policy response going to be if inflation stays persistently elevated? They didn't get that.
At all.
Not at all. It was, if you ask me, it was a car crash of a press conference. I'm going to give you an example. One of the early questions from a reporter was this: if inflation is too high and not coming down, is the best remedy to raise interest rates?
That's a decent question.
Yep. So Warsh's response is this: it's interest rates could well be part of that solution, but I wouldn't say it's in isolation.
Oh, that's a nice way of not answering a question.
Oh, he was evasive.
What's his name? Alan Greenspan?
No, I mean, he was more evasive than Greenspan. He just, whenever the reporters tried to press him on how are you going to get inflation back to target, he was extremely evasive. And he followed up that by saying the market is already doing some of the Fed's work, meaning that the long end of the Treasury yields have risen. That is effectively tightening financial conditions, which are having a slowing impact on the economy.
And what did the market do? It's done more of the Fed's work.
Well, absolutely.
It tightened further after
it was like a red rag to a bull.
Yeah.
Later on, they sort of pressed him on the 2% inflation target, whether the Fed was going soft on it.
What was the response to that?
Well, he gave this word salad of a response, a kind of rambling justification for looking at, and I'm going to quote here, a broader set of inflation data than PCE.
Oh, that one.
He's going to look at
find something that suits what I want to happen.
Yeah. Clearly, the old inflation indicators are not appropriate anymore.
So inflation, ex-housing, ex-cars, ex-everything.
Well, I don't know. He's just saying he's going to look at a broader set, whatever that means.
Yeah, okay, fine.
So investors came away from that meeting thinking, well, do I want to carry on lending to Uncle Sam at the same interest rates that I have been? Or
Building more risk. You've got to build more risk.
You've got to put more risk premium into these longer dated treasuries. They're not going to lend at 5% anymore. They're not going to lend at,
surely
5.1.
he's quite a smart guy. Surely he realised by those answers that the market would go. And he's even said the market's going to do this for me. Okay, we're going to do it.
Well, I think fundamentally they wanted. It's fine not to have forward guidance, not to be specific about what you're going to do.
Yeah. Okay.
I
can accept that. I can accept that. Yeah.
But for the last, what are we talking? 2 decades, more than 2 decades, 3 decades, there has been this. Well, it was 1993, in fact. John Taylor came up with this Taylor rule.
Oh yeah.
Which is, and look, the best way is to show you on this first chart. This is basically. It's a rules-based policy response where interest rates are set based on how close unemployment is to peak employment and how close inflation is to the target.
Right, and it gives you a number that it should be based upon those two values.
If you're deviating from either of those objectives, you're going to have to adjust interest rates accordingly. Now, this is one version of the Taylor rule you can see in the red line here.
What is it telling us it should be now?
Well, on this version, it says 5.2%.
So what, just over 1.5% more than it is now?
Yeah, but I have to emphasise, there's different ways of setting up the Taylor rule. In this particular example, I've used the neutral policy rate. In other words, the neutral Fed funds rate, I've assumed is 1%. That means the neutral real rate is 1%. So in other words, whatever inflation...
What have you set that at will affect what the final number is going to be?
Yeah, it's basically inflation plus 1%. It's got to be a real rate. So this assumes the neutral rate is 1%. If you take, there's different ways of doing it, and you can get a closer fit to the historic path of policy rates by tweaking these variables. But if you do that, then you may find that the current recommendation of policy is even higher than 5.2%. This is what I thought was the fairest way of modelling the Taylor rule.
Can I just rewind back slightly to forward guidance? You mentioned that.
Yeah.
Now, we know that he said he doesn't want to give any forward guidance, unlike the Fed of the past, fast sort of 15 years. Now, we know why forward guidance was initially brought in to reassure the market that rates were going to stay at the lower bound and they could then lend money out.
Yeah, it was the GFC.
GFC. Okay, we know that's now gone. That was an anomaly. I think in my opinion, it's a good idea to stop the forward guidance, but it now makes traders much more have to be aware of the data and the geopolitical events and price it themselves without thinking where they know the Fed's going to be.
Well, there's nothing wrong with that. But you want to have some idea, like I said, of the Fed's policy response to the data. What is the Fed going to do if inflation stays above its target? It's now been above the target for 63 months. What will the Fed do if it's above target for the 64th month and the 65th month? And let's put it this way. We've now got 2 more inflation prints and two more payroll prints before the next Fed meeting,
which is going to be extremely important.
Which will be very important. So for investors, they don't know how the Fed will respond if inflation is high. They haven't been given an indication by Warsh that if inflation stays high, we're gonna tighten policy.
Well, that's the question I was going to ask you is what core number of inflation, which is the more important of the two, what core number would make him move or make the Fed move?
Well, that's the thing. Nobody knows.
But it becomes an opinion, doesn't it, now? Because it's what people speculate, what will make him move.
Well, you've got to bear in mind, at this meeting, we already had 3 dissents. And I think last week I said Beth Hammock, Laurie Logan had already spoken about how it's better to move early when inflation is high. Right. And maybe you won't have to tighten as much as if you delay it. They were joined by Neil Kashkari the three of them voted to hike at this
But
most recent
are
meeting.
they regional?
They're all regional.
So they're not the main crop of.
It's a question. It's a vote count. Yeah, there are 7 on the main board who generally vote along with the chairman.
Yeah,
there's no guarantee of that. So, Warsh could find that an increasing number of dissenters vote to hike, but he still has a majority. In which case, I think it would be even more of a disaster for the long end of the curve
if he made them not
if
move.
He manages
to hold them the same.
And look, I've said this before. I do believe that era of low and stable inflation is over. It was an anomaly, that period after the GFC, where central banks around the world were struggling to get inflation, back to target and stay there.
So the Fed, in your opinion, is now the move will be dependent on the next 2 sets of data coming out. We'll see coming out before the next meeting.
Well, one would hope so, but even so, if for example the payroll print this Friday, I have no idea what it will be. No, it's very difficult to estimate that. It's
revised anyway.
It's revised a lot, and there's a wide band of
probably average hourly earnings is probably as important.
That is an extreme. That is also, and the unemployment rate itself, to see, as a gauge for how tight the labour market has become. But obviously, I've been expecting treasuries to sell off, and they have been. Last week was quite a significant move. If we look at chart 2, I've shown this before.
Yeah.
4.5%.
That line is a base now, isn't it? The 2 lines.
Well, yeah, 4.5% was a base for the 10-year and 5% for the 30-year, and we broke through it quite substantially over the last week or two.
But if we took this chart back to 2000, it would show you the high, how high it's come down from.
Oh yeah.
And then the anomaly was 2010 to 2022,
I've shown that.
23.
I've shown that previously. Yeah, that was the.
It makes this. It highlights this. This makes it look as though they're high. They're not.
Yeah, not. It's all a question of really expectations, investors' expectations, and their expectations are heavily biased by recent experience.
Yeah.
So we have a generation of investors who have only experienced low and stable inflation, rather than the more normal, high, volatile inflation that we had prior to the GFC. Right. So, I've been short treasuries for quite some time, and
you've made no secret of that.
Yeah, and I wrote about it. I've written about it persistently in the super macro notes.
Yes.
I did expect some kind of pullback in yields this week, but it's very, very difficult when you've got a fairly strong view. It's just impossible to kind of fine tune it
each time trying to job it.
Can't do that.
That's not. You
can't do that. So what I've done is I've got options. I've got call options to protect me on the upside. My short positions are generally structured with put spreads, and I've taken some profit, but I do expect to give some P&L back.
Trying to job that back, you can give all your P&L back very quickly by getting caught, not getting on it at the right time, etc.
Yeah, it's important when you have a strong view like this that you are able to stick with it. You don't want to miss a really big
nothing
move.
Goes in a straight line. Look at any chart. It always has wobbles, and that's it.
But I do think that right now we're in a period where it is a very dangerous period for the long end of these fixed income markets, not only in the US, but in Japan as well, in the UK.
Is the Japan still the anchor for this? Or even with the yields that have gone up, are they still the anchor? Because in other words, i.e., if the JGB, the 10-year, put on another 25, 30 basis points, would that be enough to?
Well, I think you're right. The JGBs were like the anchor for the global sovereign debt markets. They were always the super low ones, but the JGBs have been the worst performing sovereign bonds this year. the yields continue to go high. I bet it's probably a good point now to talk about the BOJ.
Okay, yeah, let's go on to the BOJ. So just to cap, the Fed, you think, give me a yes or no, are they going to hike in September, or is that an impossible question, bear in mind you don't know the data beforehand?
Okay, let me give you a more long-winded answer.
Go on.
Look, I did expect the Fed to hold at this most recent meeting.
Yeah, I think we said that last week.
We did indeed, and I gave 3 reasons why. CPI delivered a downside surprise, and I can't remember the other 2 reasons offhand. But I actually do think the data will be strong enough that the Fed will hike in September.
Will be forced to hike in September. Maybe.
Okay. We'll have to see.
Okay, that's the Fed. Let's move on to the Bank of Japan.
Yep.
Now they've got a nice toxic amount. Amount's not the right word. No, toxic mix of policies.
A toxic policy mix. I think.
They're pulling in all different directions, and they got a bit of help from Besant on Friday, didn't they?
Well, you got to bear in mind. It does seem like the BOJ is under some sort of indirect pressure from Prime Minister Takaichi to hold rates, to be very slow to normalise rates.
Reflate the economy.
Yeah, Takaichi's policy is generally to get the nominal GDP growing at a reasonably strong pace, reflate the economy, reduce the debt to GDP ratio. That's I think what her policy aims are.
Abe too.
Well, she's following on from Abe. But the problem is the weak yen is compounding the impact of rising energy prices.
Yeah.
So
you
obviously,
import your energy, you import inflation with a weaker yen.
Well, yeah, I think it's more straightforward to look at it in terms of the price of oil has gone up. The price of the dollar price per barrel.
Yeah.
And if you're paying in yen, and it costs even more yen,
it's a bigger increase.
It's a bigger impact.
Yeah.
So what the government is doing is providing subsidies, energy subsidies, household. There's subsidies for gasoline purchases. They've capped the price of gasoline. There's subsidies for household energy bills.
They might as well just write their own inflation reading out, because that's what they're doing, isn't it?
The important thing is
artificially keeping it low.
The important thing is they're providing this assistance to households at an ever-increasing cost to the government. It's a kind of fiscal stimulus, but it's widening the deficit. But it is suppressing the level of inflation, which is still around 2%. But by providing these subsidies, they are artificially holding down the headline rate of inflation.
And now we saw the US and Japan both intervening on Friday.
Yep.
In the yen.
Look, I did expect an intervention.
Yes, I think you've mentioned this before on this show and in the note as well.
Yeah, absolutely. I wasn't bold enough to buy some dollar yen puts, but
hindsight wins again.
Well, I did expect the intervention. I just wasn't sure how forceful it would be because there is still this pressure on the yen to decline, while there is this wide interest rate differential between the US and Japanese policy rates.
But intervening in the end, isn't that going to give the Bank of Japan time to sit on the hands for even longer and be even more snail's pace at raising rates?
Well, to some extent, yes. To some extent, yeah. I think I'm just kind of unsure what the US motivation was for helping out. That's what I'm really questioning.
I'll give you a conspiracy theory. Allowing Japan to continue to hold treasuries and buy more.
Well, look, that's an indirect way of looking at it. Let's put it this way: the combined intervention has had quite a forceful effect. It has driven dollar yen down 7 figures from what was a 40-year high.
Yeah.
Japan holds about $1 trillion of foreign currency reserves, a large quantity of that in US treasuries. And if Japan was intervening on their own, you could be a little bit concerned if you were the US Treasury Secretary
sell a few of
they
those.
might have to sell some treasuries. to have the cash dollars to then sell in the market. That I don't actually think that is necessarily true. There is a
repo sort of thing.
Yeah, there is a sort of repo.
Pledge the bonds and get the dollars.
I forget the acronym that was set up, but the US Central Bank did set up, or maybe the Treasury set up some kind of repo facility whereby, you can kind of borrow the dollars, you can repo your Treasury stock, borrow the
we'll give you dollars,
and
then you buy yen.
Exactly. So I just don't know why, but perhaps it was more to kind of suit Trump's mercantilist instincts. He wants to be able to sell more US goods to the Japanese. Not that this
helps.
is really, well, at the margin. It just helps at the margin. So
the question I've got for you then is, are they going to raise rates in September?
Well, I think the market is still priced as a coin toss.
What, really?
For the BOJ.
What, for 25 bips?
Yeah.
Okay. Give us a yes or no.
I would say, based on past performance, no.
No. You'll find a reason.
They'll find a
reason not to. And it won't be a good reason, but you just find a reason not to.
Well, it'll be the usual waffly forward guidance that says very, very little. It'll just say, we don't believe inflation is heading sustainably above the 2% target, and that it'll be along those lines. So, I can see that the upward pressure will persist on dollar yen. There'll be a
So is this a buying opportunity for the dollar against the yen?
Well, I don't know when the buying opportunity will come. I mean, they've really...
They've hurt a few people that had the position.
They really have.
Yeah,
felted
a few people.
Cleaned out a few speculators.
Yeah,
I think we should be clear what felted means.
Well, explain felted.
Well, let's explain felted. If you're a poker player, 1 minute you're sitting at a nice big pile of chips, and the next minute you look down and there's
all you can see is the felt.
All you can see is the felt.
The chips are gone.
So I think they've done plenty of damage, and people will be a bit more reluctant to take that. But eventually, the speculators will return while the interest rate differentials remain wide.
Okay, two other central banks to discuss. Yep. Where would you like to go next? Bank of England or the ECB?
Let's do the ECB first.
Nice and simple, really.
That is a simple one.
Yeah.
The economy's shown remarkable resilience throughout this period of high energy prices. GDP
just over 1% now for the year, is it?
Or annualized. The annualized rate of GDP growth in the last couple of quarters has been about 1%. In Europe, they report it on a quarter-on-quarter basis,
as opposed to the US.
It's important to note that is excluding Ireland. Ireland's super volatile GDP has thrown things around, but excluding Ireland, the Eurozone has grown something like 0.3% in Q2 and Q1. Unemployment in the bloc is still 6.3%. It has been there since January 25, apart from one month at 6.4.
Yeah.
And core inflation edged up.
Yes, I saw that
in June to 2.5% unexpectedly.
And the chat is that they want to get ahead of the play.
We've heard from the hawkish Eastern European Governing Council members whose economies are doing fine, and they're very much in favour of a hike.
Tell me one that's not going well. Spain's all right. Italy's all right. France is
France is not great, and Germany's not great, to be honest.
Germany's probably on the fringe of maybe picking up.
Maybe. But the bloc as a whole is doing fine, and so I think the ECB it's.
Where are they? They're at 2.25 now, aren't they? Is that where they are at the moment?
Yeah, so I think they will want to take the policy rate to the upper band of what they consider neutral, the upper end of what they consider a neutral band, which is sort of 2 to 2.5%. That's where they think, the neutral rate is.
So you see them raising rates.
So the ECB will hike, and then the Bank of England.
Bank of England, the basket case.
Well, look, I mean. The Bank of England, they're in a very difficult position. I was very critical of them back in whenever it was, just when we were coming out of the pandemic. Inflation was 5%.
Oh God, yeah.
And they dithered
10 basis points to
about the first rate hike from an interest rate level of 10 basis points.
To 25, 15 basis points.
Yeah,
raised,
a 15 basis point hike.
That did a lot. That did a lot to head off inflation.
They were way behind inflation. But the way things are now are very different. The labour market back then was, really, really picking up. Now, the labour market is incredibly weak. I've spoken about this previously.
In fact, every note that I've read of yours, weekend note, has
well,
stressed
regrettably, month after month, the number of payroll employees has been declining almost consistently. Vacancies have been going down. They're now down about 45% from their peak.
Pay growth's about under 3%.
Pay growth is,
under 3%.
Private sector payroll growth.
Yeah, that's
pay
the problem.
growth.
Public sector payroll growth is much greater than that. Pay growth is much greater than that.
And youth unemployment at a 12-year high is quite pitiful.
Yes,
but the problem the bank have got is that we have, the regulator sets the energy price cap on household energy bills. It's just been increased 13% in July. That's not yet in the inflation data. The price cap is probably going to be hiked again in October.
Yeah.
So the Bank of England, their central projection is for inflation to go to 3.2% by the year end. So the problem they've got is that the economy is incredibly weak. GDP growth is also very, very weak.
And
the labour market is on its backside.
You're going to squeeze incomes with the rises.
Hiking just because of energy price increases
seems stupid.
But by the same token, you got very nervous fixed income investors.
Because when they looked through it last time, they got their fingers burnt.
It's not just that. It's the political instability and the experience of the Liz Truss moment. So gilt yields are, the highest among the big advanced economies. And I think for investors, they want to, I think investors see the risk of inflation expectations becoming unanchored. They need reassurance that the bank is going to keep inflation expectations well anchored and other investors' expectations of inflation well anchored. They need that reassurance to be able to invest long term in the gilt market.
Agreed. And adding to that, do you feel there's an obvious answer to this question, but confidence in Burnham and the people around him? I looked at the cabinet around him, and even the Chancellor, who's probably one of the best of a bad bunch, but there's not really much there to say these are serious people who understand what they need to do to keep the economy ticking over.
You've got to give the new guy a chance. But
it's a socialist agenda. That's whatever way you look at it. You can have the right advisors, but we're tilting to the left, not to the centre or the right. Yeah,
regressively, tax rates keep going up, and yet the fiscal deficit still seems to be running out of headroom. And so,
when you lose 10,500 millionaires last year, that tells you something.
Yeah,
but
let's not get too.
No, I'm not going to get too political. No, I agree with you. Okay, so finally, UK, B of A, Bank of England stays pat. Yeah,
I think they will do their best to stay on hold. You got two hawks that voted for a hike at this meeting. I don't know whether others will. I think the governor would rather stay on hold, and we'll have to see.
Let's move on to equities. Yeah.
Yep. Let's talk about equities because it's been a bit of a wild ride.
Oh yeah, Q2 EPS growth looks like being. I think you wrote about this in the note. 48% announced so far, but it's a little misleading. Can you explain that?
Well, I've written extensively in the super macro notes, so I don't want to give all the details away.
No, okay.
Very fair. People can subscribe, see what's really going on.
Absolutely.
But obviously, a lot of the earnings per share growth, the unexpected earnings per share growth, was from a couple of very large companies hold unrealized equity gains in stocks like Anthropic and SpaceX. So these are not operating earnings per share beats. These are kind of one-off items.
So without them, what would earnings per share be?
So if you exclude two two of these particular two companies that I'm talking about, earnings per share growth would still be healthy, 25, 26% year on year for Q2. But don't forget the big jump was in Q1. It jumped to 25% or 26% year on year growth. And it's, running at that same kind of uplift in Q2 if we exclude these exceptional gains from unrealized equity gains.
So we've discussed why the earnings per share growth has been so great. You've given us the reason why. It's a little bit misleading.
Strong.
What else concerns you?
Well, there's a couple of things. One is the increasing, what I call increasingly circular dependence of AI companies on each other.
Yeah.
So, that's a prime example where they've invested in each other and they're showing unrealized equity gains for private company investments, and also like SpaceX that has just gone public, but they haven't sold their shareholding in SpaceX. But you also have within the chip sector, Nvidia is a prime example. Nvidia's created a backstop facility of $250 billion to allow OpenAI to raise debt for a 10 gigawatt data center.
So they're giving them money to give them money back to buy the chips.
Well, obviously,
is that the simplified version of it?
Well, yeah, the data center is obviously going to be stuffed full of Nvidia chips. That's
worked well before.
But that's just one. That's just a recent prime example of the kind of thing that's going on, where obviously the makers of chips are making loads of money at the moment. Demand is really outstripping supply.
So how do I keep that demand going? I give the companies that buy more
lend
chips
the money. Exactly.
Buy more chips.
Give them what's it called? Trade financing agreements.
That's what it is essentially.
That is what it is. And so, what concerns me is that I think if we look at chart 4,
stocks.
Yeah, the chip stocks. The chip stocks had the most incredible, insane rally.
That's
this
enormous.
is the Philly Semiconductor Index, which got to 75% above its 200-day moving average.
It's enormous,
which is a lot. That's nothing compared to the Korean chip stocks and the leveraged ETFs from Korea. Yeah, it is really a casino. What was that statistic?
I saw that. And I don't know whether this is true or not. And I saw it on Twitter. Some guy wrote.
Oh, it must be true.
It must be true. Yeah, 1 in 30 Koreans of the total population got stopped out in the chip stocks.
Yeah, I have heard of some.
Because of the leverage ETFs that they were all playing in.
Yeah.
I don't know whether that was true or not, and I've got no way of proving it's true, but it sounded outrageous. But from looking at the moves, maybe it is true.
Yeah, and I think a lot of investors have taken a lot of pain. Obviously, we haven't spoken about that hedge fund that blew itself up and got
bailed out
by Citadel.
Oh yeah.
But it was a similar sort of, heavy concentration of bets in the AI sector, leverage bets, completely concentrated in a few very, very volatile companies.
Big stocks.
Very big
stocks.
But leverage. These companies are volatile enough. You don't need to leverage yourself 3 or 4 times and then have no diversification. Everything concentrated in this. And of course, when things fell out of bed,
just the slightest small turn,
and that's it,
and you're wiped out. All those gains you've made are wiped out.
Yep. So that's why if we bring up chart 4 again, you look at the trajectory of the Philly Semiconductor Index, the SOX index. It's had a big pullback, not back down to the 200-day moving average, and then I think it was either Thursday of last week and a bit on Friday, a bit of a recovery. But
what do you think now? What do you think happens?
Well, I just don't think it's going to get the momentum up again to get to challenge that earlier peak.
It'll go back down to 200-day.
I think so. I think for many investors,
that's an opinion, by the way. Yeah,
absolutely, it's an opinion. Let's just be clear: this is not investment advice.
Yeah.
People have got to do their own research. This is just us
Okay.
chatting.
Your opinion
opinions.
is that's going to go. That blue line will hit the red line at some stage again.
Yeah. Well, I think, at some point it will. But I think the way things are in the short term, I just don't think it's going to get the same momentum going again. I think it's going to have another sell-off. And then my other reason, and I've discussed this previously,
I've seen this
my other reason
chart
for being quite bearish on equities, not that I expect an almighty correction at all. I just think it's going to be, heavy going over the next few months. And that's the supply of equities. And if we put up chart 3, this is from the Federal Reserve, this information. This is net equity issuance and retirement. We only have it up to Q1, which is that red bar, showing net equity issuance turning positive. So that is the difference between equity offerings and it's IPOs and equity offerings less equity repurchases and cash financed M&A.
Buybacks. Can I ask you a quick question on that? And are all the hyperscalers now curtailed buybacks while they're financing?
Well, the thing is, their cash
flow.
flow has turned negative. Well, it hasn't all turned negative, but we showed this in last week's show. But now that they are, the cash flow for many of them is negative and has dropped, and for the other two, it's dropped very, very low. They don't have the capacity to execute share buybacks. Well, they could raise more debt and
Sell more bonds and buy
more shares. But
stiff the bondholders.
Well, yeah, you could look at it that way.
Yeah.
But I mean, the sensible thing to do is to preserve cash flow by not buying back as many shares. So that's
a headwind for you.
That is a headwind. So the net that's going to be a continued headwind in Q2, but also we have the SpaceX the lockup of the employee shareholders,
shares, yes,
and the early private investors. That lockup, I think it expires at the end of this week. I'm not sure,
but the share price has already anticipated that. I assume that's where we're down 20% below. Were 20%.
We were 20% below the IPO price, but we did get up to almost double the IPO price, and we're now down to 20% below.
What a ride! This is not a little company.
No, but I mean, I just think for the employees, those who have, there are many of them on modest incomes that have been made millionaires as a result of the shares, and they've seen them at very high levels and come right down. I don't think many of them will want to hang on to the shares for the ride. I don't know. But
it probably represents a large proportion of their net wealth is sitting in these shares.
In the company that employs them. It doesn't make any sense to hang on to them.
Yeah.
And we're talking of a substantial amount of equity here. We're talking of over $100 billion worth that could potentially come to the market. So it's like I said, this is not
require liquidity
advice,
to soak it up.
But this is just my opinion. This is a further source of supply. So I think Q2 net equity issuance is going to take a leg up from Q1. Then later on this year, we may have the OpenAI offerings, the Anthropic, and whatever other stocks come to market. So I think that supply will remain a headwind.
Jonny, do you want to just summarise where you are, what we've talked about so far, very briefly, a couple of sentences, what you're thinking about central banks generally and the equity market?
Yeah, so in summary, I think we're in a higher inflation, a higher nominal growth environment. I think the equity market is going to continue to be choppy and not make much more upward progress for a time. There is a risk of a more meaningful pullback, not a massive one.
Agreed.
Some kind of pullback. Plus, I think as far as the fixed income markets are concerned, the sovereign debt yields are going to continue pushing higher, powered both by higher inflation and by
central banks
that are
leaning towards reflation.
Just dithering. Nobody. Long-term sovereign bond investors don't have the same kind of reassurance that the central banks have their back in getting inflation back under control.
Jonny, in your note, you write about this in a lot of detail, clear detail. So tell everybody who's listening where they can read this, where they can get a hold of you.
So www.super-macro.com. Have a look at the website, sign up for a free 30-day trial subscription. It's my daily note where I talk about the macro data, what it means, what the implications are. And on the weekend, I do a deeper dive and I talk about my trades that I'm doing. It's not investment advice. You've got to make your own decision about what you want to do. But at least, I try to clarify my thoughts and explain what is going on in the macro economy and what I think the implications are.
Thank you, Jonny.